Hello and welcome to the Investing on the Go podcast for our post-US election special. Today I'm joined by Justin Streeter to help make sense of all of this. He's a portfolio manager on the Comgest Growth America Fund. Thank you very much for joining us, Justin.
Thanks for having me, James. Hi, everyone.
So to just give an overview of where we are now, it's now 10 a.m. on the 6th of November. We've woken up. It's pretty clear at this stage that Donald Trump is going to be the next president. Again, he seems to have won fairly comfortably. He seems to be leading in every single battleground state. And that race, I think, is pretty much done now. We're going to discuss what that means for markets, for your investments. In terms of the other races which are still going on, the Republicans do seem to have won the Senate as well now, so they have gained the 2 seats they needed there to get a majority. So we are going to get a Republican Senate. And the House of Representatives is the one which is really up in the air at the moment. I think the expectation is that the Republicans are going to win it, but there are still some races going on in California which are unclear. I mean, that will have big implications because it will make a big difference to Trump's presidency if we have a complete Republican sweep, and they can obviously do a lot more of the things that they want to. So, Justin, I'll come to you then. So what is your immediate take from all of this, your reaction? How do you see it playing out in terms of the House? And how do you see what this means for equity markets and other markets as well?
Thanks, James. Yeah, so I guess the first caveat would be that we are, bottom-up stock pickers. We are not political analysts. We're not macro analysts. So a grain of salt with everything, as this is not really our, the top-down is not really our field of expertise. Actually, on average, we hold our companies for more than 5 years, so 5.5 years, and for our larger weights, more than 10 years. So we, by nature of our holding period, we overlap election periods, every 4 years cycle. So we don't look at we look for companies that can have all weather franchises that can do well in any environment. That said, as you spoke about, the red sweep will have consequences, and it's taking a step back. It's understandable that people voted to some extent with their feet in terms of the economic issues. We've had high inflation. We've had some spending issues, some regulation issues that people were not happy about, and so we're likely to see some changes. And one of the key changes that Trump has been talking about is on the tax rate front, where he's looking to lower tax spending to put more money into the pockets of companies and employees and consumers. It's not clear how that would have a deflationary impact, but it will likely have an impact on the bottom line in the short term. So that's the first thing to keep in mind. We also know that the Biden administration has been a little bit more focused on curbing power of large corporates, and so in terms of regulatory overview, the DOJ overview, some of these large companies. And it looks like a red sweep would potentially have less red tape or corporate oversight. We'll see. And so lower taxes would help more domestic companies, smaller cap, pure domestic companies that have a higher tax rate than multinationals that have they're taxed around the world, that can kind of benefit from advantageous tax regimes around the world. The regulation front would potentially help larger companies that are more penalized by high regulation. So there's a little bit of both there. We haven't talked about tariffs. We haven't talked about other things, but we know that there's going to be some volatility, some uncertainty. That's something that Trump, it's one of his trademarks. It's being a little bit unpredictable. And so what gives us comfort in terms of our positioning, our portfolio, is that our companies are, best-in-class companies, and they are able to adjust to changing circumstances.
Yes, I guess the headline policies which will really impact markets, I guess, will be the potential cut to corporation tax, the reduced regulation, and Trump has obviously said he wants to drill as much as possible. And then, of course, the tariffs. Now, I mean, the interesting one here is, I mean, what do you think this means for inflation? Because interestingly, a lot of voters have voted for Trump probably because they were fed up with the inflation which they've experienced for the last few years. But I think the market's expectation is that Trump is probably going to be quite inflationary, and you've seen that in the initial reaction in the bond market with bond market yields up. Is that correct? And is that because of these potential tariffs? Are they going to be inflationary?
So, well, interestingly, Trump and Harris both had an element of stimulus in their plans, with different destination, but there was a spending plan in both programs, and so there wasn't much campaigning on terms of reducing the deficit. And so, when that is by nature inflationary, and we've seen the central bank chair Jerome Powell saying that the central bank, which has done a fair amount of work in getting us down and getting the inflation down with the monetary, raising rates so that there's less money in the system, and so they've inflation has come down to these 2 to 3%, but they've said for a long time that monetary policy alone can't solve the structural problem of inflation, and so they would like more help from basically fiscal, so tax policy. If you raise tax rates, that is disinflationary. You have less money in the system, and that is what Kamala Harris wanted to do, raising the rates to 28% from 21% corporate rates. Trump is saying he will reduce them from 21 to 17%. So that's putting more money into the system. So obviously, more money in the system chasing the same amount of goods is inflationary. Tariffs potentially could be inflationary. We'll see over the long term. The X mark being, whether you can replace goods with whether you're supplying the same amount of goods with domestically produced goods, or if there are fewer goods coming in, because inflation is the amount of money chasing the amount of goods, and so depending on how many goods you have coming in, that's the question. And then the last one is labor policy, where migration plays a role in inflation as well, with wages. In the near term, it's hard to see how the policies aren't inflationary. But what's interesting is that
I guess maybe a counter is if is on the energy side, if he does encourage more drilling and allow that. I mean, could that have a meaningful impact, or is that likely to be overwhelmed by the other policies?
That could have an impact. Oil production has increased under Biden. It had increased under Trump. It had increased under Obama. So it's not clear, to what extent it's being curtailed right now. But it's that could have an impact at the margin. Another interesting thing is obviously inflation is also driven by the consumer. The U.S. GDP is 70% consumer driven, and there is this study showing that people tend to pause spending a little bit during the election year. So they looked at the home, so house prices and home appliance prices, like your fridge and other types of more cyclical goods, and they showed that people paused spending a little bit during the even years, so 2020, 2024, 2016, and during the odd years, those prices and those spending recuperated, because people like to take a breather and kind of see where the cards fall before making major life decisions. And so that's kind of the X factor: is, are people, it's the confidence in the economy, it's confidence from the consumer. Do they want to keep their money in savings? Do they want to go out and spend? And so that'll be a determinant for inflation as well, obviously.
And what implications do you think this result has for the Magnificent Seven and big tech? I think there was perhaps a perception before that Trump wasn't a huge fan of big tech, but that seems to have changed with this election campaign. Obviously, Elon Musk has been a huge vocal supporter of his. It seems like Silicon Valley has really changed their tune and got on board, and there's an alliance there with Trump. So is this a good result for big tech and AI and all that sort of stuff?
That's a good question. And, the Mag 7 make a lot of headlines. We have some of those in the portfolio. Taking a step back, it's interesting. I don't think a lot of people have in mind that over the last, 1 year, 3 year, 5 years, people think that, there's only 5 companies that did better than the S&P 500, but there's actually if you look at the components, there's more than 200 companies that do better than S&P 500 over 1 year or 3 year or 5 years. So about 40-something% of the companies, which makes sense because the S&P is a weighted benchmark, even though some companies are getting larger. But not every Mag 7 has done better than the S&P over 1 year, 3 or 5 years, and so that's one thing to keep in mind. Now, the focus on the Mag 7, there has been a little bit of evolution. I mean, we know that the tricky part is that President Trump has a stake in a social media. He has Truth Social. He has he'll likely give a key role to Elon Musk, who also has a stake in social media, which these companies typically get their money from advertising. So it would look like there's a bit of a conflict of interest in the advertising space there and the social media space. That said, I think most recently he said that he wouldn't like to break up Google while Google is undergoing currently the DOJ investigation, because he says, his words are, China is afraid of Google, which is, it is important to keep in mind that, these are large local players. And so we will see what the new administration's approach is. But as I mentioned, I think there was a stat the other day showing that, 60% of the S&P 500 is under DOJ investigation right now, 60% by market cap, because there are large companies and there has been more of a willingness in the current administration to go after large corporates, a little bit more intervention in terms of like the corporate space. And so that would likely change a little bit. Now, the difficulty is there's a bit of a conflict of interest. So we're not sure how this will play out in the near term.
Very interesting. And so as we record this, we've got US equities up. We've actually got European equities up, which was a bit of a surprise to me, given the fear over tariffs. Chinese equities are down as expected, given that's where the greatest burden of tariffs is to fall. I know you're a US manager, but what do you think this means for global equities, and particularly for places like China? Are these potential tariffs going to be devastating for them? Or
you really asking me to look beyond my remit. Well, actually, in our portfolio, we have about 60% of the revenues from the US, and then the two next largest regions are Europe and Asia. And so we do keep those regions in mind. Obviously, it's not clear to me that there's a lot of low-hanging fruit. I think the world is, let's say there'll be, you can call it tit for tat, or you can call it transactional, or you can call it a multimodal or something. But if you change one thing, not everything else stays the same. So, we've seen with the European approach to put tariffs on EVs, and then China said they would put their own tariffs on other things. So that's the area where you're not entirely sure what the consequences will be. And we rely on China for a lot of goods in the manufacturing process and the supply chain, and also as a market, and so it is an interconnected world, and so it's not as simple as some people may wish to believe. That said, we have seen the U.S. trying to become more self-reliant on critical tools, for example, with the CHIPS Act and the IRA that Biden put together, and some debate whether that was inflationary or not. But interestingly, we've heard rumors in the financial press that some of the large corporate leaders are gently asking potential President Trump to not repeal those. Those trends have been set in motion, and then they'll take the time they take to have. It takes years or decades to build this infrastructure, and so it's not clear yet. What kind of new tariffs will be put in place and how successful they'll be.
Yes, and I guess we'll have to wait and see what happens on the geopolitics front. Trump has promised a lot in regards to Ukraine and so forth, but we'll have to see what happens there. Who knows? And just finally, then, Justin, are there any particular sectors which you would be more interested in today, or would avoid as a result of this?
As I mentioned at the beginning of the call, we have a low churn, so we keep our companies for more than 5 years on average. And our top 10 weights, they're about 60% of the portfolio. We've had them for over 10 years. So we are believers in long-term trends. So while there may be a little bit of volatility in the short term, I think last time in 2016 there was a bit of what they call the Trump bump, where some value companies had done well because there's lower regulation, maybe around some of the clean energy or a debt stimulus, or there is the lower taxes that can help sometimes lower quality companies. But over the long term, we still see similar trends, which are we want to grow GDP with a lower impact on resources, and so with a potentially aging population, with the global climate questions, and then the reshoring questions. And so what we're trying to do is do more with less, or do more efficiently. And so these are when we can find companies like Eli Lilly that are helping solve the obesity pandemic in the U.S., where 40% of the population, adult population, is obese or overweight, and they're helping patients lose over 20% of their body weight, which helps with comorbidities, which helps with skeletal issues. It has a whole lot of positive impacts on the patient and on society. So that is doing more with less. One example, or a lot of our tech companies. And companies that are not called tech, but are in other areas of industrials or healthcare or consumer, are finding solutions to do more with less. Whether it's Avery Dennison's RFID tags to track labels when you're shopping, and so you don't need somebody to help you check out. You can check out yourself. Or whether it's Oracle's AI cloud and SaaS products that are helping companies do more with less and find value in their data, and maybe potentially lower the healthcare spend, for example, in the US. These are interesting long-term trends that we are attracted by, and they are, by their nature, if they are mission critical, and if they are helping solve a high level, long, structural issue, then they are more protected from short-term trends, because they are necessary and they're important for the long term. So that's what we look for in companies. And so we're not going to change the portfolio very much in the short term. We'll keep our eyes open if there's opportunities, if there's some volatility, which volatility is always a potential factor. But we believe if you have the best companies, if you have the strongest companies you can find, those will be the companies that actually benefit from volatility. So that's what we'll be looking for.
Yeah, that makes sense. Well, thank you very much for joining us today, Justin. Really appreciate your insights.
Thank you, James. Have a good one.
And there you have it, listeners. So that's our initial take on the US election. It does seem as if Trump is going to win, and actually win the popular vote, which is something he didn't manage to do in 2016. So thank you very much for listening.
Comgest Growth America is an unconstrained, highly concentrated portfolio of between 25 to 35 companies. This quality growth strategy endeavors to find the highest quality companies that meet their stringent ESG criteria across the U.S. To learn more about the Comgest Growth America Fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts. Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.